Hello ladies and gentlemen, welcome back. I'm Sanford Kahn, and this video is about how to make money by selling mini call options on Apple computer. Why don't we get into it now? I don't think you're watching this video for my good looks and charm, so let's see how to make money by selling mini calls on Apple computer. Usually a call option, one call option represents 100 shares of a stock by definition. People, when you sell somebody a call option, you sell them the right to buy 100 shares of stock, whatever company is, GE, Apple, name Hewlett-Packard, whatever company, all the Dow 30 have call options, within a certain period of time and at a certain price. Now, there are some exceptions to this, and Apple is one of them. It's a well-known company. It's held by a lot of people. If you wanted to buy 100 shares of Apple and sell a call option, you could do it, but that's a lot of money. This chart here is actual prices taken in October of Apple, actually October 15th. And it was going for one share was going for $501. 100 shares would be over $50,000. That's a lot of money for most investors. Even for a lot of investors who are upper income, that's still a lot of money. Apple is one of the 3 exceptions on stocks that has mini call options. A mini call represents only 10 shares, which is how I started out selling call options on Apple. I'm giving a presentation on something I did, so it's not like I'm just telling you to do something and I haven't done it. I've done this and it works, but there are risks. Like any investment, there's no such thing as a risk-free investment. Let's get into it. One mini call on Apple is 10 shares by definition. So let's say you buy 10 shares of Apple at the price on October 15th. It was $501. That would be $5,010. Well, that's affordable to great majority of investors. $50,000 would not be, but $5,010 would be. You go ahead and sell somebody the right to buy those 10 shares now. This is on the options exchange. It's in personal market, just like the New York Stock Exchange. It's a Chicago Board of Options Exchange. You sell somebody the right to buy your 10 shares of Apple between now and the 3rd Friday. Most of the calls expire 3rd Friday in January for $520. You bought it for $501, and you sell somebody the right to buy it for $520. You're 10 shares now. It's a mini call. And for that, you receive $178 before commissions. Speaking of commissions, always do this with a discount stockbroker. Don't go to a full broker because they'll rake you over the coals on commissions. $178. What is your rate of return? And then I'll get into your risk. Your rate of return is $178, just simple division, divided by $5,010. All rates of return are expressed in annualized rate of return. I'm using a banker's year of 360 days. Instead of 365, I use 360. And when I sold this option, it was 93 days till expiration. I got these numbers from TD Ameritrade options chart. I pulled it up, and they tell you how many days to expiration. A lot of companies have that. I just use TD Ameritrade. I'm so used to it. I'm not recommending it, but I'm used to it, so I use it. So the rate of return is 3.55%. That's 178 divided by $5,010. Simple division. And then you divide 93 into 360. That's 3.87. You multiply this through. That's 13.7%. Nice hunk of rate of return. Sure beats 1% in a CD, doesn't it? But then you're not done yet. So that's 13.7%. Plus it has a dividend of 2.4%. At these prices, the dividend yield on Apple is 2.4%. You add the 13.7 plus the 2.4, and you come up with 16.1% rate of return, annualized rate of return. Now you could say, that's great, and it is great, but there are risks. I use this, I do this, and I'm willing to accept the risk. And as I talk about in my book, which I'll get to shortly, the primary criterion of any investment is not rate of return, it's suitability. You have to judge if this is suitable for you. But I can tell you this right now, what isn't suitable for you now may be suitable for you down the road. The rate of return on this, if Apple stays constant, is 16.1%. Any stock, including Apple, has three ways it could go. It could go up, go sideways, it could go down. Well, Apple is a very volatile stock. If you follow it, I've seen it move 20 points in one day. It's unusual. Usually it moves 5 or 10. But it is volatile. The chances of Apple going sideways is very remote. It could happen. If it does, you'll still get your 16.1. If Apple goes up, and it goes up to $520 by the third Friday in January, it's going to be called away from you. Your 10 shares will be called away. But you bought it at 501 and you're selling at 520, your rate of return will actually be greater than 16.1%. On the other hand, there's always the other hand in investments. And matter of fact, there's always the other hand in life too. If Apple goes down, what happens? Well, if these 10 shares should plummet in value by more than $178 between now and the third Friday in January, you will actually lose money. You will actually take a loss. That's the risk. If it goes down and doesn't go up to 520 by the third Friday in January, this option that you sold will expire worthless, because why should somebody buy it from you at 520 when they can go into the market and buy it for 500 or 490 because it went down? This will expire worthless. Then you go out and you sell another one. You may not get $178, you might get something less. That's the risk you take. But look what you're doing. You're generating cash flow from Apple stock, much more than the 2.4% dividend. You're sacrificing that Apple could go up to 600, but you're saying to yourself, I'm willing to sacrifice some rate of return for greater cash flow now. There's always trade-offs in the stock market. This is what I do in my account. I used to have a lot of mini calls on Apple, and then I wrapped them all together, and now I have 100 shares of Apple, and I sell a regular call. But this is how you start out. This works, but you got to know about the risk. You got to ask yourself, is this suitable for what I want to do? Now, I'd like to get into the book called The 13 Great Economic Business Myths That Dominate Our Lives, and I'd like to critique this book. You should get this book. I'd like to critique it. This is a good book. I'm just joking. It is a good book. But you need to read chapter 11 because this is where it starts off. I talk about investments. Personal investing is a tricky and complicated affair. That's this. For those who don't like to do this strategy on individual stocks, how I started out doing it is on the whole market. You heard of the Dow Jones 30. There is an exchange-traded fund called the Dow Jones Diamond, symbol DIA, that represents every stock in the Dow Jones Industrial 30. It goes for about $156, $157 a share. What I started out doing is buying 100 shares of the Diamond, that would be $15,000, $16,000, and selling a call option. You're monetizing the Dow Jones 30. You're reducing your risk because now you have 30 stocks, basically, you're selling a call on. I explain this in this chapter in detail. A good example how to do it. How to monetize and make extra income by selling call options on the Dow Jones 30. You're now doing it on 30 stocks. I used to do that on the Dow Jones 30. Once you do it on the Dow Jones 30, you could graduate and do it on the S&P 500 by an exchange-traded fund called the SPDR. SPY. It's the most heavily traded of all the exchange-traded funds. Institutions use it all the time. You could then sell call options on the SPDR. It follows the same procedure as doing it on the diamonds. Exact same procedure as I explained in chapter 11. No different. It actually is like this. But one of the advantages of going to the SPDR, SPY, is that they have mini call options on that too. There's 3 stocks that have mini calls: Apple, Amazon, and Google. And then the exchange-traded fund, SPDR, SPY, has mini calls. Works the same as this. Works the same as the diamonds that I explained, Dow Jones Diamond, in the book right here. If you get the book, and I encourage you to get it, I need to warn you of something. The advice I gave in chapter 11 was good when I wrote it. It's very good on using the Dow Jones Diamond to monetize. You could spend it. This $178 is yours to keep, no matter what. You could go to Vegas. You go out to dinner. You could go to the Polo Lounge at the Beverly Hills Hotel. A nice place to go, believe me. You can even have dinner there. But the second part of the chapter, you should not follow. You definitely should not follow the advice in the second part of the chapter now. I talk about how to buy U.S. government securities. I talk about they're the safest investment in the world. At the time I wrote that, that was true. I cannot in any way recommend any individual buying U.S. Treasury securities. Because if the United States keeps going down the road it's going now with its debt and spending, if it keeps going down the road with its debt and spending like it is, and there's no reforms, the United States will, not might, will default on their Treasury securities. They will default. They'll do it one of two ways. The first one is an outright default. Well, they'll only pay you 50 cents on the dollar, something like that. The most likely way they'll default is by running up the printing presses and churning out dollars and paying you in worthless dollars compared to what you originally invested. The United States is a unique country, but we obey the same laws as any other country in history. Then the debt burden becomes too large, they'll try to inflate it away, and you're going to be paid off with worthless dollars. There's two other chapters in this book. You should get the book. It's available. It's on Amazon.com in Kindle format for $3.99. At least that's the price when I just last checked a day ago. It probably still is. $3.99, no shipping, no tax. There's two other chapters you should be aware of. One of them is chapter number 12, where I talk about the new feudal society, how to survive and prosper in the new age of new business lords and new business serfs. What do you want to be, a business lord or a business serf? It talks about the new feudal society. When I wrote that chapter, which was really based on an article I wrote 7-8 years ago, actually a little bit more than that, I got lambasted on the internet because I posted it mostly by college professors. Guess what? We are now in the new feudal society, a new age of business lords and business serfs. How do you survive and grow in that society? I think you should read chapter 12. That's extremely important because we're there now. The other chapter is chapter number 10 you should read. It is the myth on the positive mental attitude myth. PMA, I think they call it. Positive mental attitude myth. You need to read that. This is a bunch of nonsense that you've been sold that you always have to have a positive mental attitude. It's garbage. Since when is the weather always bright and sunny? It changes. Attitudes change. There's something much more important than a positive mental attitude that will help ensure your success and advancement. Read those two chapters, number 12 and number 10. And number 11 gets into how to sell call options on the Dow Jones 30, how to monetize it. You need to read that too, but don't follow the second part of that chapter where I talk about buying treasuries. Just put a big X over it. It's not good advice. So it's good advice at one time, not now. Anyways, get the book on Kindle, on Amazon Kindle. Until we meet again, as I always say in my videos now, thumbs up.